Welcome back to Good Returns. I'm Matt here with
Garrett. I'm Garrett.
Stock sold off this week as yields pushed higher, consumer data softened, and Bitcoin did something genuinely interesting that we want to spend some real time on.
And in the planning room, we have a Social Security discussion, specifically the decision most people make too quickly, the argument for taking at 62 versus waiting, and an honest conversation about what that decision actually costs if you get it wrong.
Yeah, and a quick note before we get into it, everything on Good Returns is for educational purposes only. Nothing we say is personalized financial advice for your specific situation. Make sure to reach out to
Let's get into it.
A trusted advisor. And if you don't have one, go to momentumwealth.us and we will be more than happy to give you our opinion.
Now let's get into it. Yeah, sorry. Kind of ran over you a little bit there.
Difficult week for some of the indexes. S&P down 1.9, NASDAQ down 3.1, Russell 2000 down 2. Technology was obviously the worst performing sector, falling 4.2%. Value did hold up better than growth, down 0.6 versus 3.2. That's really good to see that. If you have a diversified portfolio, that value aspect really helped kind of anchor the portfolio going into this week. So it's a pattern you'd expect to see when yields are rising, which we saw. We did see yields rising, some interesting things occurring on the long end of the yield curve. And when, high beta, high valuation stocks are under pressure.
Yep, we had energy lead again this week with nearly a 5% gain as oil moves higher. Healthcare being the other bright spot there as far as performance. Interestingly enough, the equal weight, you talked about the S&P 500, which is the market cap weighted version of that 500, or really more than that, but down 1.9%. The equal weight only fell 0.9, which we would consider sort of flat.
Yeah.
Less than the headline, which tells you concentration, there for the selling at least was definitely in those large technology names, as evidenced by the NASDAQ, really.
Yeah, very interesting. You had the value of bonds falling, of course, as Treasury yields rose. The 30-year yield climbed above 5.3%. Now, that's a level we haven't seen since 2007. Corporate credit spreads did, in fact, widen, and the dollar weakened about 1%. And your volatility index, the VIX, drifted ever so slightly higher.
And you have the Treasury now talking about the yields on bonds and actually raising their buybacks. They went from 2 to 4 million. And then yesterday, I think he said, billion, 2 to 4 billion. And then he said they were going to do even more. So you did see like an immediate reaction to that in the bond market. Mm-hmm. When he said that, they were going from 2 to 4. And then the next day, which I guess would have been yesterday, you had another fall and they are going to do some more buybacks. But all that in the face of Bitcoin in the news again, and will be in the news, I imagine, for at least a little while longer, gaining more than 14% for the week. We're going to cover that more in one of the takeaways because the context around that move is very interesting and worth understanding. We've had it happen a couple times where Bitcoin kind of comes alive, I guess you could say. But it's looking a little bit different this time. So we'll talk about how that is.
Yeah. And it's really more than in the last 7 days. Because a lot of times when we're compiling this data into the format for the show, it's considering the trading day week, Monday, Tuesday, Wednesday, Thursday, Friday. Bitcoin trades 24/7. So if you look on the actual week, it's up like 23%. So even, 50% more than the 14%. So significant gains. But let's get into what drove the week. Heard some stuff, not too much. Didn't really permeate the financial media as much as it would have necessarily in the past, just I think maybe because of that Treasury announcement. But the consumer kind of softened a little bit.
Yeah. We had 2 consumer data points come in this week, and they're both sort of pointing in the same direction. You had retail sales in July falling 0.6%, first monthly decline in several months. And then the sentiment, consumer sentiment that is, fell from 51 to 55.2 in June. Fell to 51 from 55.2 in June, which reverses 2 months of the improvement that we saw there in that metric.
Yeah, I mean, the spending number, it does kind of have a caveat worth looking at. Amazon's Prime Day was in late June this year. So that likely pulled online purchases forward. So July's weakness may be in part reflecting the fact that people kind of spent more in June than they otherwise would have. So people, obviously if you spend all that on Amazon Prime Day, you didn't spend it in July. So you take out autos and gasoline, but sales still fell little over 0.2%. So it does suggest the weakness was a little broader than one category, but I think the Prime Day effect is that made the number appear worse than it otherwise would have been.
Yeah, the sentiment number is a little bit harder to kind of look at with rose-colored glasses. 51 is a pretty weak reading. And the specific data point that jumped out to me is we got only kind of 8% of consumers expect their income growth to outpace inflation over the next year. And in December, that was 18%. So that's a meaningful shift in how people are feeling about their own purchasing power. I'm assuming it's having to do with a lot of the oil stuff that we're seeing as well. Again, this whole conversation is framed in short term versus long term for us. And really, the only thing you see when you're asking these types of questions on a consumer sentiment level, when you're asking somebody to kind of forecast out what their longer term outlook is going to be, it's only based on the short term data that they have available to them. And so, I don't know if, I don't know how much stock to put into it at this point because it changes so drastically. We just talked about last week where we got this metric where inflation was basically non-existent outside of energy prices. And will that continue to be the case? And does it have any effect on this? It'd be interesting to see as more data comes out about this, as we get more of these readings over time.
Yeah, I mean, they're not wrong. I mean, wage growth has always lagged the debasement of currency, really and truthfully. It always has. So whether 100% of people know that or 5% or 8% feel it, it doesn't. It is truth. And I think that when people begin to align their spending with their sentiment, that's where you kind of get some worrying signs potentially. But it is worth noting that sentiment and spending don't always move together. Case in point, it's generally always true that wage growth is generally less than inflation, or generally less than GDP most of the time. And so there's this kind of constant nagging at the where labor's just not ever able to kind of keep up unless you're owning assets, which is, where we come into play, retirement planning, and you put money in your 401k, et cetera, kind of what drives that whole thing. But you'll have periods where even though that may be true, sentiment is very positive, so it keeps consumer spending up. So they don't always move together. But to see sentiment low and spending to soften a little bit, I think that's why people are starting to scratch their heads saying, okay, well, we need to pay attention to that and see if the consumer is in fact cracking or not.
Yeah, I don't think I would say the consumer's cracking. Total retail sales are still up like 5% from where we were a year ago. But the trajectory that we've seen over the past 2 months with this data coming in certainly suggests that the consumer spending is moderating, at least at a very minimum. And so for the Federal Reserve that's trying to decide, according to metrics that the market, whatever that is, would ascribe to it, whether the hike or hold in September, this data would suggest the holding pattern would continue, which is kind of what we've talked about.
Yeah, it would not suggest a hike, right?
Correct.
Because if the consumer's softening, you don't want to hike. And the consumer softening is in alignment with the thesis that commodity shocks that drive up consumer spending in very specific cases, such as gasoline at the pump, deprives them of purchasing power elsewhere, which can make them spend less money elsewhere, which could make the Fed actually cut rates, not raise rates, because that is not an inflationary dynamic.
Yeah.
So that's where we're at. We got to remember when we're looking at these things, we're seeing these headlines. We got to be able to read through it, and that's how you get to, for whatever reason, if the consumer is reducing their spending or softening, because of their concerns over prices or whatever their concerns may be, if they in fact are slowing down spending, then you are going to absolutely not get a hike. You'll probably get a hold. Yeah. Could make the case for a cut. No, probably not in September, but
I don't think we're going to see that before the end of the year. But it's something interesting just to bring up is that this is all kind of predicated upon how the Federal Reserve has worked thus far under chairmen that are not Kevin Warsh. And so Kevin has already come in and said, I'm changing things up. And so he's talked about his view of the dual mandate and how, they're not actually at odds. They should be kind of supporting one another. And so how he interprets data from consumer spending to inflationary concerns to employment, all that kind of stuff is going to naturally be different in his frame, in his worldview than it has been, like under Powell or someone like that. So that's another thing that kind of the normal thing would be to say, oh, well, we've been with Powell so long and we know kind of how he thinks, and this, leads to this data point leads to this outcome, and it's going to be different now going forward, I think is what we've been told to expect. So I would be interested to see what they do say at the next meeting if he does choose to do a presser at their next meeting, which I kind of hope he does, because I do want to kind of hear how they're looking at the kind of the real world shifts in this data. I think that'd be interesting.
Yeah. Another interesting aspect of this week's headlines is the 30-year Treasury yield getting over 5.3% for the week again, which is the highest level since 2007. And the interesting thing is that yields aren't just, high. It's that they're high in an environment where consumer spending may have missed and sentiment may be falling, which is not a normal pattern that you would see.
Yeah, normally when you have the economy showing signs of softening, investors tend to buy treasuries, which is, you can think of this as the safe haven or the flight to safety is how it's sometimes described. So when demand for the treasuries rises, those yields tend to fall. And that's been the historical relationship that we've seen. And it's why bonds have traditionally have provided portfolio protection during periods of weaker growth. There are sometimes, obviously, when we didn't see that. But historically, that's what you would expect to see.
Yeah. So you have growth softening and yields rising. Anyway, I don't know. It's interesting. Some contradictions going on.
Yeah, it's kind of pushing against historical patterns. So the first force that we could think of that's pushing in opposition to this would be kind of inflation. Persistent inflation concerns, mean the bond market isn't convinced that weaker growth automatically translates into lower prices. And the Fed may need to keep rates higher to finish the inflation fight. So the bond market is pricing that uncertainty. And that's, if we look at what Besant came out and said, with the way the Treasury is going to look at this, he thinks the bond market's wrong. I mean, that's what he just came out and said. Like, the bond market is wrong. They're thinking this, and we're thinking the opposite. That's why we have to do these Treasury buybacks. That's kind of his rationale for it. And whatever you think about that, he's the Treasury Secretary. So, I mean, what he says goes. Now, if it's the right move, we'll figure that out later. But that's at least their framing of it currently.
Yeah. I mean, that is the primary stated reason by aggressively spending. Now, these bond buybacks started in 2024 for market liquidity needs, and then were expanded last year, and then expanded drastically 2 days ago.
Yeah,
this week.
What is the final number? Do we know that?
No, we're not going to know it probably till Monday.
Oh, really?
Yeah.
Because it's initially was a $4 billion, was going to double it, but now they're thinking it's higher than that.
So they're basically saying that there's what you had said, the U.S. economy's true underlying fundamentals are not being reflected. Now, there is one second here. Something that may not be being talked about very much, but is something to consider, is that you've had a record selling of bonds by the mega cap companies to finance their build outs. So we don't know, how many long dated treasuries they ended up selling to finance the build out. That's what I was trying to look up here.
We also have foreign governments participating in the selling as well.
Yeah.
Japan being one of them.
Yeah, trying to prop up the it's hard. I think it'll take a little time to get it, but I think that I think it would be significant. Regardless, there is selling pressure. There's selling pressure both on any treasuries they may have been holding to get the cash, and then there's also, for instance, say if Google or Alphabet, that is, issues a bond to raise money to build a data center. Google's a pretty solid company, right? Strong balance sheet. They issue, say, a 5 or 6% bond. Well, you may want, as a bond investor, you may want that 6% coupon rather than the 4% Treasury.
Yeah,
As well, so it's increasing competition. But it'd be interesting. I can't get any real time data. The thought just entered my mind. Surely, these companies that have been sitting on some cash like Apple, selling their treasuries now in order to finance some of this AI build out. I wonder how much that plays into there being a mismatch.
Yeah, well, we talked about Berkshire Hathaway too, coming off their stockpile of cash and buying equities,
which are going to be treasuries. When these companies hold that much, they're not actually holding cash. They're holding treasuries.
Yeah.
Now, what duration of treasuries are they holding? That's we don't know. They're speaking specifically about there being a mismatch in the market in the long end of the curve.
Right.
So we'll see. This has happened in the past. It started in 2024. Before that, it happened at the turn of the millennium. Is it millennia or millennium? I'm not sure, but it happened there. And then in between the world wars, and maybe after World War II, I know definitely in between World War I and World War II it happened. So there is a precedent for it, but it is an element of market intervention, and it is designed to try to put a cap on interest rates. And we've talked about this, and I'm sure anyone listening has heard other people mention it too. Interest rates are on a downward trend, and there are many reasons why that is, but the numero uno reason is the national debt.
Yeah.
And that's the very same reason that some people will say, well, the Treasury market is experiencing this because the government keeps borrowing money and the deficit keeps growing and we're now at 40 trillion. That may very well be true, but that reality is why interest rates will in fact go lower.
Yeah. Well, the other thing that they're talking about is being able to grow your way out of it. And a lot of people are, $40 trillion is a lot of money, is a lot of debt. But at the same time, you're the number one economy in the world and you own basically the currency that's used worldwide. So it's a little bit of a different conversation with that sort of environment rather than if you were, any other country basically. But still not great. I mean, we definitely have to get a handle on spending for sure, but that's, easier said than done.
Yeah, I mean the grow your way out. Again, you'll have 1 to 2% inflation, so that'll be your debasement rate. And then if your economy's growing above that, then you're creating a gap. You're having growth. You're able to essentially grow your way out of the debt problem because as a percentage of the overall value, the debt becomes less and less. So 40 trillion is a lot, but when you look at the total value of the U.S., the total, I guess if you had to say what's the net worth of the United States, I mean, some people put it as high as 300 trillion, maybe more. So, it is a big number, but we are also a big country with a very, very large economy. I think the biggest thing is you want to see that a healthy gap between what your GDP number is, what your inflation number is, and as long as you kind of keep the growth of the debt less than GDP, then you're fine, I would think.
Knock on wood. Well, the practical implication for the conversation around bonds, and we kind of talked about this earlier, a couple episodes ago when we talked about 60-40 portfolios, but those long-duration Treasury bonds, they may not provide the same cushion during periods of weakness that they have historically offered. And we saw this in 2022. That's exactly what we saw when the conditions produced this kind of one-to-one sort of bonds and equities falling, at the same time. It's something to keep your eye on. And bonds there's been a lot of downward pressure recently in the price of bonds. I mean, there's no doubt about it. So long-dated bonds, I guess we should say. Yeah,
and it doesn't mean not to have bonds in a portfolio. Short-duration bonds, Treasury inflation, other instruments, they all can serve a purpose. But definitely, the assumption that like a long-dated Treasury automatically protects you when stocks fall, definitely that assumption deserves scrutiny because it's not always the case. That's why in the bond strategies that we deploy inside portfolios still have a growth almost. It's not really a momentum factor, but it's a very growth oriented. We want total return. We're not holding a particular bond because it's just what you do. We're not holding the aggregate U.S. bond solely because that's just the index, right? We want to look and see, are we in an environment where high yield will outperform? Are we in an environment where ultra short-term treasuries makes the most sense?
Yeah.
And you want to be tactical in making those decisions. So it's just definitely the assumption that money has to sit in a long-dated bond definitely deserves scrutiny, and it's a conversation worth having with your advisor if you have not already done that, because going into retirement and holding an enormous amount of fixed income instruments is not necessarily the right decision. That could be a very, very big money-losing decision. So MomentumWealth.us.
As it was in 2022.
As it was in 2022. Yeah, absolutely.
Even your 401k is not shielded from this. Your 401k has the bond options in it. Most of the time, those bond options are going to be more intermediate to longer term bond positions.
Correct.
Some 401ks, we do see some, Treasury, inflation protected securities. Sometimes we do see some high yield options, not very frequently. Most of the time in your 401k, your bond area is going to be moderate to long term. And so when you're in when you're in an environment of downward pressure on that, and you have those limited options that 401ks usually only have, 15, 20 options outside of those target date funds. What do you do if you're close to retirement? Let's say you're 60-40 portfolio and you want 40% in bonds, but you can't really go to the total return fund or the bond index fund. How do you think about those? That's a conversation we have constantly, and how we think about it is we end up using more cash. You use more money market funds. You use more stable value funds, things like that for very short periods of time. Now, you don't want to go in those and stay in there for decades, but at least as shelter from the storm, those tend to be a better, output or a better turnout rather than holding those bonds. And again, this is generalized advice, not personal advice. If you have a question about this, if you have, some question that you want to ask, if you're close to retirement, if you've got a large percent of your 401k in bonds, you got to talk to somebody about it. Don't just make those decisions based on what we're saying here.
And if you are a bond investor simply because you're not an equity investor, right? That's okay, but you still have to understand when the right time to own the type of duration and security. Just like you're saying, sometimes cash or a 1 to 3 month treasury is the best option. Sometimes it's not. And in fact, strategies like we use, when you historically backtest them, you can start to get significant alpha relative to just holding that aggregate bond fund that's in your 401k that since 2003 or 4 would have gotten you 3% a year.
Yeah.
You start getting tactical, and you can start imagining a world where 7 or 8% a year is not an impossibility. It starts to become it's not nowhere near as exciting as your 10, 11, or 12% on your equities, but you can start to see where you can get more meaningful return if you're managing the duration and the quality rather than just holding the index. So it is something to think about.
And that's a nuanced conversation.
Of moving parts to it, for sure.
Not a lot of people have that conversation. What we tend to see more of, even with our own client population, if you remember back to 2021 or 2022, we got calls from people who are a little concerned about the frothiness that we were seeing in the market through that bear market there in 2022. And the conversation that they wanted to have was, let's go somewhere safer. And that was a pause for us. Like, okay, let's do that. But what do you mean by that? And we had to expand upon that because it's not just go to bonds, because that was a losing strategy.
Correct.
And at that point in time, we were not in those bonds. We were using cash for that. So that's a conversation that has to be had, because it's, for a long time, it's been equities, risk, bonds, safe. And it's 2022 showed us that's not always the case. So you have to know the environment that you're in. Yeah. You have to know where you need to go versus where you think you need to go. And that's where the value of having a conversation with somebody who has a little bit more information, has a little bit more context, and can break that down into, a conversation that you can understand. They're not talking above you. They're not throwing jargon words at you. they're just having a conversation about this is probably not the path to go. If you feel this way, this is a valid feeling. If you feel, anxious in time periods where the market is frothy, it's perfectly valid, but we need to figure out what the real solution is versus just something that you heard on Facebook or TikTok or whatever. Instagram.
Yeah, absolutely. And speaking of things you're probably going to be hearing on TikTok and Instagram, while the bond market and the Treasury and all the talking heads fight over whether inflation is at 1.8% or 2.8% and which one means victory and which one means defeat, Bitcoin kind of showed everybody this week that, 1.8% versus it's still debasement of currency. Yep. It is still destruction of value of purchasing power over a long period of time. And the Treasury's move to intervene, I think, was kind of the catalyst for Bitcoin to blow past its 200-day moving average and get back to doing what it was designed to do.
Yeah, I mean, we're going to talk about Bitcoin, but you're also seeing the similar sort of thing happen in mining stocks and metals and things like that. So that's interesting. But Bitcoin did gain more than 14%, as you said. I'm going to look at the 5-day. Yeah, because it's like 22 or 23% really over the past week. And it crossed what's called its 200-day moving average. And before we explain why that matters, we want to explain what that means, because it's one of those terms that gets thrown around a lot, and you're going to hear it in the financial news. You're going to hear it on the talking heads. They're going to talk about this 200-day moving average because it's a big deal that it crossed the 200-day moving average.
Well, it is what it sounds like. It's the 200-day moving average is the average price of something over the past 200 trading days. Generally, it takes and kind of smooths out on a line all the price action, so you can kind of see what the trend is doing, where it's been. And so when you have that average and you see the real price cross above that line, it is a signal, at least in the short term, that momentumwealth.us, that momentum has shifted in a way that is consistent with a longer term trend improving in price. So technical analysts pay very close attention to it because historically assets that cross above the 200-day moving average tend to have a better forward return than assets trading below it.
Yeah, so
and that's very true. It's not a risk-free, clear, you're out of the woods signal, but in general,
it's a bullish indicator.
Is an indicator that is right more than it's not.
Yeah, so it's worth asking the question, does this week, kind of the price action that we've seen, does it begin a new leg higher? Or is this going to end up in another kind of bull trap? And we'll fall further from here.
No, I mean, I'll go ahead and take the risk and say that the bottom is in. The bottom is in. I suspected that was the case when we wicked down that weekend to whatever, 54, 55. It was real quick. I suspected that was probably the bottom. I think this confirms it. This is the context, though, upon which I would say that is you've had. It really wasn't just a bounce because you had Bitcoin's move higher again, some 20 some odd percent in the last 7 days. Mm-hmm. Ethereum up.
Let's look at it. I'll look at it.
Let's see real quick here.
27, 28. Yeah.
There it is. 28%.
Let's look at gold. What about gold?
It ain't no 28%.
Yeah. No, it's 5.
Yeah. Yeah, 28% in a week. I mean, just those that have been patient, you're getting rewarded for that, and that's great. And
the miners are 14 to 15.
Yeah, the miners are. I think you'll see some periods of outperformance. With those miners, because the price of gold has kind of stayed elevated. Even though we had a little pullback, it has really stayed elevated. But you had Bitcoin moving higher, you had Ethereum moving higher, you had gold moving higher, you had the dollar weakening, then you had the move of the Treasury planning to increase buybacks of long-term bonds. That puts downward pressure on yields and long-term inflation expectations. But it's showing you a signal of government debt management, meaning that as everyone knows, they're going to do whatever it takes to get the value of that debt inflated away one way or the other, to keep the whole system going as what people will just say it's a continuation of the debasement trade.
Yeah.
And this has been a long-term trend that was happening before COVID. COVID really shed some light on it because the spending was significant, stuff we had not seen since World War II. And, all magic comes with a price.
Yeah, I mean, the debasement trade that you're talking about, basically assets that hold value when people worry about currency or government debt, they're all kind of responding simultaneously. So that's what kind of piques our interest, makes us kind of sit up. Gold up, Bitcoin up, dollar down. This isn't like a short squeeze story. Although there have been a lot of short squeezed in this run up, an enormous amount actually.
The most ever. The most ever. And, as we were compiling the data, which has to be done before this morning, the price range to hold was 72,000. As we're sitting here, we're at like 78.
Yeah. I'd be very, very interested if we can make it up to 82. I think you see a flip there. But I don't know. I'm still not convinced. I think that, I certainly hope that we would have found the footing. I don't think it's outside the realm of possibility that we see another leg down before we see another leg up, but that's total speculation. We don't know what's going to happen. We don't have a crystal ball.
And for long-term investing, it doesn't matter. It's more like an interesting thing to watch than it is because your longer-term trend is intact. And for listeners who don't own Bitcoin, understanding what the debasement trade is very, very important to long-term portfolio construction. And, it's there's so many aspects to why blockchain technologies, things such as Bitcoin and Ethereum, have become so dominant in the conversation of the new economy. But, as we know, Bitcoin's primary value proposition is store of value, and value that cannot be inflated away. And of course, for other areas of blockchain technology, such as Ethereum, the value proposition is different. I mean, there's some similarities, but it is a different value proposition when it gets into tokenization and things of that nature. But you're also going to be seeing in this next bull run that I believe we've entered with Bitcoin specifically, you're going to see an intersection of blockchain technologies and artificial intelligence. Because when you really start looking under the hood of how AI agents operate, it's really made for Bitcoin in the transacting between AI agents autonomously. I'm going to be very interested to see if those two narratives converge over the next couple of years. I wouldn't say it would be any time like real soon, but over the next 12 to 24 months.
What you're basically explaining is you have, let's take, for example, the betting markets, where you have agents that they're allowing to go onto these markets and make bets for you, basically. And they have to have access to some sort of funding mechanism to do so. And so the blockchain and crypto specifically is a very natural entry point for that.
Yeah, because it's a permissionless financial layer, right? AI bots lack a human legal identity, so they can't go and open up a traditional bank account, but they can use digital cryptographic currency in order to exchange value and to autonomously hold value, hire other bots, pay for computing resources, to be able to function and exchange value without using the banking system. So I'm going to be, very. I believe those narratives will merge together, and I think that's going to be incredible opportunities for those that have been patient investors and holders of blockchain technologies such as Bitcoin and Ethereum, because I believe they're going to see value accretion, the likes of which they probably have not anticipated. But we'll see. I mean, and it could watch next month. You're going to start seeing like headlines about Bitcoin and AI, but I suspect it'll take some time. I don't think we're quite there yet, but
we'll put a pin in it.
We're already seeing Bitcoin miners start to kind of merge with AI compute contracts. So you're seeing from a hardware perspective, you are seeing a little bit of cross-pollination. That's not what I'm talking about. I'm talking specifically about the use case of either tokenization through Ethereum or value exchange through Bitcoin by autonomous AI agents.
Yeah. Well, We'll see. We'll put a pin in it.
Yeah, we'll have
Write
to.
it down, the
We'll
date
have to.
and time.
We'll have to
your
circle
bet.
back.
Yeah, circle back to it.
We'll have to circle back to it. Well, let's look at the planning room. Talk about Social Security, the decision most people feel like they have to make very quickly. It kind of feels like it's sprung upon you. You know, you spend your life working, and Social Security is always something that your parents did or your neighbors are doing, and it's still far off. And all of a sudden, boom, you have a decision to make. And, you know, that decision consumes a lot of bandwidth, of mental bandwidth, but in a very short period of time. It's like, oh crap, 62, what do I do?
Yeah. And 62 really is the first opportunity you have to take. You have sort of, I mean, you can take anywhere from 62 to 70, but your big inflection points tend to be 62, full retirement age, which tends to be 67, or 70, which is the latest you can take. So, you know, I kind of want to start this with a framing that sort of, this is how we look at the conversation. Most people think of Social Security as, you know, they're getting their money back for something that they paid into. And they paid in for decades. They want to collect what they put in. They want to take it as soon as possible. That's sort of a natural human instinct, the way to look at Social Security. And we see that a lot in our client base as well. I don't know what you're thinking, but I mean, share with the class.
No, just the notes the note that you put here. It's true. I mean, I was going to let you read it.
What?
Well, the on this particular topic.
Oh, did I skip over something? Yeah. Well,
yeah,
I mean,
I didn't know if you were going to read that or not. I was just, it's true though. And there's nothing wrong with it. It's just.
Well, I think that, you know, anybody who's listened to the conversation or listened to the podcast, any clients of ours may know that historically, maybe I'm a little bit more emotionally invested in client conversations and the all that kind of stuff. And you're more, you know, analytical numbers type of person. But in this instance, we kind of swapped duties because we just had a conversation yesterday. If there's a client that comes, you know, and wants to have this conversation about Social Security, I'm going to try to encourage them to delay as long as they're comfortable doing so. And you will generally be the one that says, you know, let's talk about, should we take a 62? And my sort of knee-jerk reaction is, aside from a major health issue that's going to shorten life expectancy, I would rather delay past 62.
Yeah, I mean, it's true. I mean, we can look at explaining that. I mean, I wouldn't say in all cases there is that split, but I would say that it definitely, because what it is it's the division within our own brains of that kind of mathematical, you know, quantitative side versus the emotional qualitative side, right? And so that's
kind of what investing and retirement planning all is.
And it exists within all of our minds simultaneously, and we put more weight to one versus the other depending on the circumstance of the situation. Yeah, so generally, you know, Garrett's going to push more towards really claiming your true benefit, because that's what your benefit is.
Yeah.
And that's what is lost in the conversation most of the time, is that when you get to be Social Security eligible at 62, that's not your benefit.
Correct. That's not your full benefit.
That's right. Full retirement age is your retirement age. So it's more or less a mindset shift of 62 is not really retirement age. 67 is really retirement age, right?
Yep.
And then
you get a permanent reduction of about 30% if you claim at 62. So that's you accepting 70% of the money that you are earned. If we're taking the example of, I've paid into this so many years and I want to get back what I've earned from it, you're taking 70% of that in exchange for being able to access it earlier than you otherwise would be able to.
Yes, which creates a break even of, say, 8 or 9 years, meaning that you have to live 8 or 9 years past your maximum Social Security age to materially notice the benefit of delaying. Now, that is a real mathematical reality. And so it is something that really has to be taken into consideration. But the other side of the equation is, you know, you literally only live once. So you have to figure out, what are my odds?
Yep.
And then how does that affect my other assets? And you can answer yes to the question, do you have enough saved for retirement? And the answer can be yes. And then the next answer is, do you want to wait to take Social Security? And it can be completely different. So you can have two clients that have the exact same amount of money saved, and the rationale for taking or delaying can be just completely different. And that's okay.
That's the behavioral side of things.
Because if you, for instance, if you feel like you have enough saved, you don't care to wait. You want to hedge on using the money now while you're alive. And then if you feel like you have enough saved, you can also say, I can wait because it doesn't matter. I have enough. I can draw off my retirement. I'm not even going to miss the Social Security. Ergo, I'll wait. And maybe my spouse is a little younger, and so it's kind of an extra insurance policy for them, et cetera, because her benefit will kick up or whatever it may be. So it really is a longevity insurance.
Yeah. I think there's a couple of ways we hear this conversation brought up, typically framed by clients. A big one is, if I take at 62, I can take that Social Security check and I can invest it either in the market, or I'll put it in a savings account at the bank, or whatever it is, and I will continuously do that time over time, and I will be better off by the time I'm full retirement age, and it won't matter. I will have compacted essentially that break-even point that you just talked about. And so we have to, when we have that conversation with the client, generally what we will do is we'll bring up the behavioral side of that, which is that if you miss one of those payments because life happens, let's face it, your grandkid wants to go to camp, or your refrigerator breaks, or whatever it is, and you don't, the first month you don't take that Social Security check and put it into the investment, then the math changes completely. The growth rate changes completely. The contribution rate, it's all different. And so if month 2 comes by and your washing machine breaks, month 3, you got to put a new roof on the house. All these things compound on each other. Then it just gets to where that's easier said than done, basically. And that's the kind of the reality that it's our job is to bring that up to people. It's the whole behavioral part of it.
And I know that maybe we can clip this, put this on the YouTube shorts. But I think Dave Ramsey says to take it and invest it, take it early and just invest it.
Does he?
In a mutual fund. Could be wrong. Sorry, Dave, if I am. But I thought that had been a oft said comment. Yeah, check this. Fact check me here in the real time to see if that is the case before I continue.
Well, this is going to take me some time to look up because we have a fast internet
connection. It shouldn't take that much time. Come on.
Yeah.
Okay.
He favors taking Social Security at 62 when it becomes available.
And then doing what with it though?
I'm gonna have to read this. Hold on one second.
Can we play Jeopardy music, or is that a copyright thing? I guess.
Yeah, we probably get copyright struck for that.
For while you're looking that up, it's just on the spreadsheet it works.
You can invest the checks yourself. So it's something like that. Yeah.
That really comes down to that's a decision you can make only if you feel like
that's interesting. I didn't know that. That's completely different. I didn't mean to run over you, but this is completely outside of that. But that's very interesting that he has that view.
And it comes down to whether or not you're going to abide by the spreadsheet. Which if everybody was running their lives with spreadsheets, right?
We meet some of those people, mainly engineers.
But if everybody was, right, it wouldn't be that hard of a decision to delay or not to delay,
right?
Because you've already kind of gotten everything lined up. So it's just, I don't know. To me, it's like this is where our income strategies come into play, and this is not on the show notes at all. But just to me, that's why it's so important that the way we manage portfolios is really designed around giving clients optionality in that early part of retirement, in that 62 to 67 age, so that whether it be a good healthy mix of Roth versus non-Roth monies, or just being able to take, instead of taking the 4% rule, maybe we take 6%, maybe we take 8% income, so that you then have the freedom and flexibility to make the decision around Social Security based upon other factors, not based upon being able to make the rent or the mortgage or the car note for this early retirement time period. So I think the decision to take Social Security, ultimately, if you're analytical and you're using the spreadsheets, that's great, value that. But I think the decision to take Social Security really needs to be based off of all the available information and knowledge you have of how long your natural life will last outside of an accident.
Yeah.
To me, I just keep coming back to that. And that's a hard thing to know. And all you really have to go off of is what's your health like now? and how did your parents die? Kind of your family history. And then I guess into that mix, you could throw in if your spouse is materially younger than you or has a pretty sizable gap in what their Social Security benefit is and what yours is. Because the longer you wait, the bigger their spousal and or survivor benefit will be.
Yes, that's a huge, I know that just like was a comment you made in passing, but that's a huge argument for especially married couples, because the higher earner, the one with the higher Social Security benefit, that's going to be the survivor benefit. Mm-hmm. So if that person takes a reduction in their Social Security benefit by claiming earlier than full retirement age, that is something that in perpetuity exists. You cannot go back and change that. So that's your benefit, and that's also the survivorship benefit. So if you want to take a 30% cut on that, that is fine if you understand that, but you have to understand what that means in the future for, if you're the higher earning spouse, if you have the higher Social Security benefit, what that means for once you are no longer here for your survivor.
Yeah. I mean, there's benefits. It's such a mixed bag. Like we were talking about, the income aspect of it, so we come in and provide the ability, generally speaking, on average, to offer optionality with income that's higher than what people would normally expect. Okay. Yeah. So if we're already doing that, but then a client decides to take Social Security early, well, what's the pro of that? Well, the pro is that we get to reduce income. So more money stays in your portfolio and it grows and you have more money in the future. So it's just not that government guaranteed inflation adjusted income, but you still are going to get better growth on the portfolio. It'll be more money for you to take in the future. So everything is a whipsaw. I think the way that Garrett approaches it is generally right in that remember your benefit is at full retirement age. They're not paying you to wait. They're penalizing you to not wait. And when you think of it that way, then it helps reorient what your expectations should be of how long you're working and how much you should save. And then from that, factor in health, factor in, like we've had clients before that are single that are prioritizing long-term care planning for what happens with their portfolio, so they can make sure they have optionality because, they're going to be having to kind of take care of themselves to an extent, and they want to make sure they have enough assets 15, 20 years from now. And so keeping that income muted and moderated now gives them optionality in the future for long-term care needs. So ergo, they are going to prioritize taking Social Security earlier than someone who may have a different support mechanism at home where they're not really concerned about what long-term care looks like.
Yeah.
So all of these things, it's not purely math. So that's where, kind of the
that's
analytical
why there's no right
aspect
answer.
It's
different for everybody. Literally, it's different for everybody. You can have, to your example earlier, you can have a household of two spouses come in, we can meet with them at 10 a.m. and then we can have another group, another household come in at 1 p.m. They have the same exact assets, the same investment makeup, the same risk tolerance, everything. They could pick two completely different Social Security claiming strategies, and it's okay.
Yeah.
But it's just the goal is to know what what the trade-off is and to understand it, to make sure you understand it. As long as you understand it, as long as you know what you're going into, that's the decision, as long as you're comfortable with it.
Yeah.
The other thing to think about, though, because it doesn't come up a lot, it probably would deserve its own kind of financial planning room topic, would be taxation. Up to 85% of your Social Security benefits can be taxed, and it's based on the other income that comes in. And so when you're looking at kind of trying to balance, to your point, the portfolio income versus the Social Security income, this is another big thing to take into account. Now, the state of Georgia has very good state income tax exclusions on seniors 62 and above. And a handful of other states do as well.
Arkansas does too, I think.
Yeah, so there are states that treat it a certain way for the state tax portion. So you can do some fancy footwork to kind of get your federal taxes where you want to be. But again, it takes planning. That's the whole idea. That's the whole name of the game. A lot of people sit down with friends, or they look at their Instagram feed or their Facebook feed. They get advertisements by financial advisors all day long, and a lot of people may be thinking, do I need a financial advisor? Like, what's a financial advisor? What are they going to do for me? Well, these are the kinds of things that, come up in those conversations. And, it can be daunting, and you can kind of be, intimidated in a certain respect if you've not had an experience with a financial advisor. But I would just urge you to put that out of your mind, because it's just a conversation. That's all it is. It's a conversation about where you are and where you want to get to, and how do we make that happen?
Yeah, absolutely. And sometimes it's not a straight line. You're gonna iterate. You're gonna improve.
Oftentimes it's not a straight line.
And you're gonna be able to, use the value that we've accumulated from our experience with thousands upon thousands of interactions with clients that have made the right decision, the wrong decision, an okay decision, made a wrong decision and then changed it and made a right decision, and be able to use that experience that's been built over many years to help save you from making the wrong decisions. And the wrong decision for you may be waiting to 67 Social Security. It may be taking it early at 62. It may be not understanding your Medicare options at 65. And these things have nothing to do with what the S&P 500 did this week. Right?
Yeah.
But it could be significant, hundreds of thousands of dollars of value swings one way or the other. So it is very important. That's why we always say, go to momentumwealth.us.
Yep.
If you don't have a trusted advisor. And if you do have a trusted advisor, ask these questions. And they should be able to help you. And if they're not, well, then go to momentumwealth.us.
Yeah, that's what good financial planning is for. And you're right. It starts with asking the right questions.
Yep, I agree. I agree 100%.
I think we've come to the end of it.
Well, let's just end it right there.
Let's just end it right here.
I can't find the end, so you're going to have to.
I will end it for us.
Here it is. I found it. And that's good returns. Thanks for spending time with us.
Yeah, well, subscribe if you haven't. Share it with somebody who you think would find value in it, specifically if you are, around any circles of anyone talking about Social Security, or that's a decision or inflection that they're going to come up upon, retirement planning, all that kind of stuff. Leave some comments if you've got some comments. We're always down for that. And anyway, we hope you have a great rest of the week, great weekend,
absolutely.
And we'll see you back here next week. Same time, same place.
Take care.
See you later. Bye-bye.